Hey, everybody. Good to be here today. It's Friday. We're almost done with the week here, the work week at least. Hope you all have had a good week, and the markets have had a pretty good week, haven't they? So we'll try and cap it off with a good session today. Advanced options. We're going to continue our series today. This is number, I think, 7 in our series. Today we're going to tackle diagonal spreads. I want to talk about those. I think it's a versatile strategy. I think you'll like them when you look at them. Of course, none of what I go through is a recommendation necessarily, but it's a recommendation to experiment in paper money on these would be what I'd say here. Good to see some familiar names in the chat. Glad to have you there. Also glad to have Barb Armstrong in the chat too. Barb is a wonderful teacher, and she teaches several classes, including a trading a smaller account class. So if you have a smaller account, even if you don't, honestly, you're going to learn something from it. Make sure you check that out. You can follow Barb or myself on X at Brentmore CS, at Barb Armstrong CS. Let's hit up the disclosures and we'll get to diagonal spreads. Options do carry a high level of risk and are not suitable for all investors. And the information today is for general informational purposes only. It's not an individual recommendation of any particular security, chart pattern, or investment strategy. And Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money software application is provided for educational purposes only and may not factor in commissions in what I'm doing here, but just realize commissions are a factor, especially with multi-leg options trades, which we'll be doing today. And all investing involves risk, including potential risk of loss. And there's no guarantee of an execution of a stop order that is going to be at or near the execution price. And we'll be looking at different stocks, different trades today, but none of those are recommendations. They're just examples. There, let's take a look at the market because the market's up yet again today. It's quite a run up. You know, we're almost back. I mean, that's like a high. That was an all-time high there, I think. So we're not that far off of it. And I think you're probably hearing a lot of people saying, well, maybe we're a little bit overbought in the short term. So I don't know. I don't know if that means we're going to turn around or not. Right now, the momentum's up. The trend is up. Shorter term, intermediate term trends are up. And but, you know, I'm starting to hear a fair amount of people question whether the run up is, to the extent it is, justified. I'll let you make that decision. And of course, you can do bullish trades or bearish trades in this market. We'll try and look at both. I try and look at both each day. And what I want to do is I want to kind of go through the general plan here is I want to look at some of the basics of diagonals, number one, and then I want to actually use specific examples on trading diagonals here. So I'm going to do what I've done in past sessions in this series and just kind of write out some the basics of diagonal spreads, and then we'll go through to some of the actual just application here on this. But as I go through these, I'm trying to give you both the theory and the practical application as we do these. And of course, as you have questions between Barb and myself, we'll do our best to answer your questions there, okay? So what is a diagonal spread? You're going to do one long option, one short option. Of course, you could do multiple contracts of these, different expirations. And that sounds a lot like a calendar spread because diagonals and calendars are very similar. But here's the difference. Different strikes. That's what makes it a diagonal versus a calendar spread. Different strike prices in addition to different expirations. We're going to sell near term. We're going to buy long term or long dated option. Technically, you could do the reverse. That would still be a diagonal spread by definition, but that adds an extra element of risk in the equation there. because potentially you could end up with the long-term expiring or something, and then you're just left with a naked option there. So typically we're going to sell the near term and use the longer dated option there. How do they differ from diagonal? Excuse me. How do they differ from calendars, other than the fact that you have different expiration dates? For calendars, we always call them kind of non-directional trades. These are what I'm going to call somewhat directional. Okay, they can be more directional or less directional depending on the strikes you pick. Technically, you could do a call diagonal that's bullish or bearish. You could do a put diagonal that's bullish or bearish. But in general, what we're going to be looking at is call diagonals. The way we're going to do them is going to tend to be more bullish, but we'll also look at a couple variations in the money and out of the money, which I'm going to get to in just a minute here on some of the differences on in the money and out of the money diagonals. And we don't always talk about those. Number 4, these are generally positive theta. I'm going to put generally next to that because it's not always the case, generally. But here's the thing. Calendars are more about theta. Calendars are more about vega, generally positive vega as well. Diagonals, probably more about the direction. Okay, so we're going to de-emphasize the Greeks here on diagonals. Excuse me. We're going to de-emphasize those Greeks. We're going to emphasize the direction a little bit more there on those. All right. So there's that. In terms of strike selection, the short option, so that's the near dated one, usually will go maybe 20 to 40 days till expiration. These are just general guidelines. I violate these in this class even. I will violate this quite often. So this is certainly not set in stone by any means. But just to give you a starting point, I'm going to say the short option 20 to 40 days to expiration, the long option 50 to 120 days till expiration. So those are just kind of some guidelines on what we're going to pick. We're going to sell near the 30 delta. Again, we can tweak that a little bit. Remember, delta tells you how much the option is likely to move given a $1 stock and the move in the underlying stock price, but it also can give us an idea of which options we're picking, how far in the money or out of the money we're picking. A delta of 50 is typically kind of at the money or near the money. 30 delta is going to be out of the money. That's the short option. We're selling that one. Now, what about the long option? Well, this is where it's going to depend. I'm going to distinguish between out of the money diagonals, and that is the long strike is more out of the money than the short strike. Okay, so that's an out of the money diagonal. I'm going to call this typically more neutral. And one way to think of this trade is this. This is like a vertical spread. Like if I'm doing a say a long call vertical, okay, a short call vertical. I'm going to sell a call and I'm going to buy a call or do a long call at a higher strike price, right? So that's a long call vertical. But they're the same month. In this case, what we're going to do is we're going to do the same thing, except we're going and we're just separating the expiration dates here. So here's an expiration date here. Here's a later expiration date there. That's our out of the money diagonal. That's a less frequent one, than what I typically show, but I want you to be aware of it, and just I want to give you an example of that today as well. And in the money diagonal means that the long strike is in the money here. Okay, long strike is in the money. So that's our and it's typically more bullish for calls. Okay, and let me just check my notes and see if I'm missing anything. What's my next point here on the list? Okay, where are we gonna exit these? And there's a survey link, by the way, in the chat. We appreciate your feedback. Hitting the max gain is very difficult on these. You'll hit a max gain, but that's going to be a single point. It's like a calendar. A calendar spread, there's a single point that's the max gain. Reaching that max gain is probably unrealistic. And so we're going to exit 25 to 50% of max gain. Okay, so that's one exit. We'll have several exit points here. That's if things are going well, we'll exit there. We're going to exit on technical breakdown. In other words, if we're bullish, if it goes bearish, we'll exit, and vice versa. Typically, we'll use like a contingent stop. I'll show you that. I'll demonstrate that. Contingent stop is kind of preferred. You could, I think, you can also do just a traditional stop level on that. A contingent exit. In other words, what I mean by that is we're going to exit based on the stock price, not the option price. You could do a stop based on the option price as well. You can do that, no problem. And so we'll look at that, but that's often the case we'll do for that. And then we'll have an expiration exit 10 days to expiration or less. We'll look to get out of those. And I think I have one more. Let me just see if I've missed anything here. Yeah, one more thing I just wanted to mention, that is money management. And just like the others, other trades we've looked at in this series, we're going to say 1 to 2% of active trading portfolio. Okay, so that's it. I want to look at the market, and we'll look at some examples on these. So this is there's your diagonal spreads. I do not have this published anywhere, but if you wanted to write those down, you're welcome to, or do a screenshot, or whatever feels best for you on that. But let's look at some examples here on this. So what I'm going to do is I'm going to bring up our Thinkorswim desktop software platform, and I'm going to start off with the put diagonal, because it seems like I start with call examples. We're going to pull up a more of a put example. And here's my rationale on the put here. And the general trend has been going down. That's the reason there. So Josh asked a good question. I didn't put the delta on there. I didn't put the delta on that in terms of the delta for the long option. Usually probably looking around the 60 to 70 delta range. It would be a typical delta for our in the money diagonal. Okay, in the money diagonal. Out of the money diagonal, it's actually going to be a lower delta than what the short diagonal is. For an in the money, 60 to 70 maybe, something like that would be my take. And another question was, what about if you get what if you, on this, these will be debit spreads, if on the in the money at least, there'll be debit spreads. What about exiting at a 50% loss? Yeah, you can exit at 50% of your debit. Absolutely. That would be so when I talk about doing a stop based on that, you could do a 50%, maybe even less. Because sometimes on those diagonals, um, you potentially risk a lot more than you potentially make. We'll see on it. Depends on them. Just depends what strikes you pick. So you could put that stop at 50%, or just as an example there. Okay. Martin said, question, can you do them with index options? You can do them with index options. Absolutely. Yeah, you sure can. So, so let's do this. So here's AbbVie. Here's my, thanks for the questions, by the way, everybody. Good questions. General trend has been going down. That's my assumption here. I'm going to assume we have some potential resistance that's supposed to probably be near where our most recent bounce was, which I've kind of covered up, but our most recent bounce right around there. My assumption is that's going to continue. That general trend is going to continue. So let's look at a typical diagonal spread. I really think they sound very complicated. And when I listed it out, it sounded like there's a lot of moving parts. There's really not, every trade has complications to it. And I don't want to say it's simple. I won't say that. But it's not as complicated as you may be imagining on it just from the name. I think people can get intimidated by the term diagonal spreads here. Okay, so let's look at AbbVie, and what I'm going to do is I'm going to just kind of follow our initial rules on this, assuming we're bearish on this. I'm assuming that I have a resistance around 190 there. Okay, that's my most recent bounce. I'm just going to put a little mark on the chart here. I'm going to assume we're going to stay below there and maybe go down lower. Hope, the plan is a bearish trade here. So what I'm going to do is I'm going to go to the trade tab. I'm going to kind of follow the rules more or less that I said. I said the short leg, how many days till expiration? I said 20 to 40. So I'll go out 28 days to expiration here on this one. Okay. So let me go 28 days to expiration, and that's between 20 and 40. I'm going to do puts, so I'm going to be looking at the right side of the page here, and I'm going to look for something around a 30 delta. Well, we got a 29 delta here, and I'm going to sell that. I'm going to click on that. Okay, simple enough. We're going to start with that. Okay, now for my long contract, I'm going to go out and I'll do 50 to 120 days to expiration. Well, we'll go 63 days to expiration. Okay. So I'm going to go to July 18th contracts. Again, I'm going to go to my puts. I'm going to go in the money, delta 60 to 70 delta. We'll go 60 delta here. I'm going to click on my ask price, and I forgot to hold down the control key. So when you forget to hold down the control key, you replace the other one. Let me hold down that control key on the first one there. I think we had that right. 175 put. So let's analyze this trade and just take a look at this. Notice it's a debit spread. They're debit spreads. I'm going to analyze this trade. Let me go to risk profile on this, and let me just scrunch this just a little bit so we can take a look at this. Now remember what we said. The stock right now is at about 183. We think it's going to stay below that 190 level. We think it's probably going to bounce down from here. So we're bearish on this. Let me go back to analyze. And here's the current price. You can see that on this red line, excuse me, not the red line, the vertical line right here. And you can see it's bearish. Okay. So let's just take a look and talk about some of the attributes of this. Max gain. Well, here's the $500 level. Our max gain is actually a little bit above 500, but realistically, hitting that right on the nose is probably unlikely. But anywhere down here, it doesn't matter how far we go down this way, we still are in a good position. This is a bearish trade. Okay, this is a bearish trade in this case. Now, what's my what's my max? I think one of the questions in the chat was, what's my max loss? My max losses are my initial debit on this. So my max loss is going to be around, you can see it in the bottom of my screen there, about $950 is going to be my max loss on that. So we could put an exit at about half of that. Half of 950 is going to be, what's half of 950? 475. We could put a stop based $475. But my max gain, one of the concerns about that is this. If my max gain is a little bit above 500 and we exit about half of that, then I'm looking to get out at $250 gain on this trade. Okay. And so do you see one of my concerns about waiting for it to get to the 475? Admittedly, we're in, it's a getting down there it's going to take a little while before we get there, and we may very well exit before that point. If the stock goes bullish on us, we're going to look to exit this before we hit our stop in this case. All right, so that's that. That's the trade. It's positive theta in this range. I mean, here there's not much of a theta impact. This is all positive theta right here, where the purple line is below the blue line, okay? That is all positive theta. Notice it can switch to be a negative theta trade, though, if the stock goes up. We're not planning on going up there, and we're not going to hold on to it very long if it does go up there, likely. But just realize that's why when I say theta is, well, you can see that right here. Here's your theta right down there. Positive, positive, negative theta if it goes against us enough. So generally positive theta on that. But again, theta is not the main driver of this. This is a more directional trade. What I'm going to say is we're getting out if we break above that 190 level. Well, that was the kind of resistance level on the chart there, the most recent bounce on the chart. We'll be in a losing position at this point. But we're going to be a long ways, likely. I mean, I can't make any guarantees on that, but it looks like we're going to be a long ways from a max loss at that point. So that's where we're going to look to get out there. And I'm going to look to exit at about half that, we'll say $250 gain on that. So let's do that as a trade here. Let me go. Before I send that trade though, so let me just complete the thought on this trade. Then I want to show you a little variation on the trade of doing an out of the money diagonal. Same trade, switching it to out of the money though. So I'm going to make this a first triggers OCO. I'm going to right click on it. I'm going to create an opposite order, and I'm going to have two of those. So 2 exits there. Okay, so that's my entry. Where did we say we were going to get out? Well, I'm going to change this to a market good till canceled order. And we said we were going to get out if the stock goes above 190. That means it's going against us. I'm going to click on my gear. I'm going to go here. I'm going to click right under symbol. And I'm going to say if it marks greater than or equal to 190, or I'll give it a little wiggle room above the 190. I'll go to 191 there. Okay. I'm going to save that. Now, on this, I also said, well, I'm going to exit if we've made $250, okay? Well, $250. Well, we're getting in for what are we getting in for? $950. So $250 would be $12, okay? So we can get out for a $12 credit on that. That would be wonderful. And I'm going to make that a limit order and good till canceled on that. This is a first triggers OCO. What that means is none of these exit orders are going to come into play unless this initial order fills here on that. And then if one of these fills, it will cancel the other one and vice versa. Okay. So there we go. Let me get out of this drawing tool deal here. Okay, you're certainly not stuck to these expirations. In terms of our debit, that's a mid price. That may be a little ambitious to get in on that. I'm going to confirm and send. Actually, before I send that though, let me just show you something. Let me go back to that Analyze tab. And I want to show you another possible variation on this here, okay? And that is, what if we adjust this this 190 put, and instead of doing the 190 put, I'm going to keep the same expiration, but what if instead we were to do something that is out of the money? Let me just see if I can get my, so we're going to July and we're doing puts. We did the 190 before, but I'm going to go in the money. I think we sold the 175, so I'm going to go to the 170, and I'm going to click on the ask price on that. Okay, so let me go here and hold on one sec. 175. Sorry, let me put this in just so we can compare side by side. June 13th, 175 short. Okay, now let's look at this. And I want you to see the difference between these. Okay, here was our initial trade that we demonstrated here. And one thing you can see is, you can see the more it goes down, it doesn't matter how much it goes down. We're still making money on this, okay? We're still making money on that one. But it goes south up here. Our max loss, we said the initial debit was $950 would be our max loss on that. Our max gain on that, we said, was a little bit above $500. Okay, now take a look at this. What if instead of doing that, we keep the same short strike, but we change the long strike here? Now, remember on the other one, the more it went down, it didn't matter. If it went down, 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 we were still making money. In this case, if it goes down, it gets worse and worse and worse. It gets in bad shape here on us. So by switching that from an in the money to an out of the money, the long contract, we didn't change the short contract. We changed the dynamic of the trade. Now it peaks out here, and let's just see if we can find out our max gain on this, about $322. Not as much of a max gain, but if the stock goes up, our loss isn't nearly as great on that, okay? So this has shifted it from I'm not going to call it a bullish trade, but it's more of a neutral trade. There's more of a neutrality to this trade. So what I would say is this: you can try out different strikes and different expirations here, and that's one of the good things about this risk profile tool, is you can experiment with these. And you can look at them and you can say, oh, you know what? If instead I do the 175, I do the let's see, that's a long option. This is going to make it a calendar spread. Okay, same strikes. Let me go up a little bit more. 180. You see how it's shifting as we shift these numbers here? So play around with it and find what makes most sense there in this case. In this case, I sold the 170, which, remember, these are puts. So these are further out of the money on this. That's what I did. So Chris said, why did I sell the higher? I sold the lower strike on this one. Okay. This was the initial, in case I'm confusing anybody on this. This was our initial trade right here. In this case, I am showing you the alternative of doing what we call an out of the money diagonal here in this case. You will notice, as you see, if you attend this webcast often, and we've done diagonals in the past, I almost always do in the money diagonals. Okay, that's 90% of them I do, but I just want you to know you can do them out of the money or kind of in between. You can do at the money too, I guess, if you wanted to, by adjusting your strike prices there. So, but just notice notice how things change when you change those strikes there. The typical long diagonal that we're doing, the typical long out of the money diagonal, in the money diagonal, is much more directional than if we do the in the money diagonal, little less directional on that trade there. Okay, I'm hoping that is making sense there. This is the sold. The one in the red is the sold one, the sold contract. Okay, this is the long contract right here. I may have said it wrong initially. Okay, but yeah, there we go. And why is that? Now I've changed that. Hold on one sec. Let me go back to the original trade. Let me just unrelease this. That was the original trade. Here's the other one there. So anyway, okay, let's move on. I was going to send this original trade though. Okay, so let me confirm and send, and we're going to put this in our diagonals category, and there we go, and it just filled. Okay, and we have our exits in place on that. Let me show you another example here today. And I want to go here, and we're going to change this to Walmart. Okay, so here's Walmart, and here's my assumption on Walmart. This is technical analysis, and I'm kind of saying, this is looking kind of cup and handle-ish, a little bit more bullish here. Okay, a little bit more bullish. All right, and if I confused you on the whole in the money, out of the money thing, for now, just basic stuff. Let's just stick within the money diagonals with the rules that I originally or guidelines that I originally posted there. And we're going to focus on the in the money diagonals right now. Okay. Long strike in the money, maybe 60 to 70 delta-ish is what we're going to be focusing on there. Okay. So I wanted to give you the example of the other, but this is really what we're focusing on here in the money diagonals. All right. So let's go on and let's take a look at Walmart. Okay. And in this case, I'm going to look at a bullish trade because my assumption is, hey, look, the trend has been going up. I kind of mentioned that cup and handle thing already. Looks like it's kind of a flag pattern where we had a nice bounce. We had earnings, and earnings was maybe a little bit mixed, but it's had a nice bounce off that at this point. So this is going to be more of a bullish trade. So Lisa said, when you're talking about out of the money, I'm referring to the long strike only. The long strike only. The short strike, whether we're doing out of the money or in the money, our short strike is the same. We're still looking somewhere in the 30 delta-ish range here on that, okay? That's for my short strike. That's for my short strike. So when I've said long in the money or out of the money, I'm just referring to that long strike there, okay? Here, what we're doing, 30-ish delta. Now, we probably often aren't going to get exactly the 30 delta, but let's take a look at it. So we got trend, we've got bounce, we got cup and handle, and what am I going to do? We're going to go to the trade tab. We're going to go to our short leg, and I'm going to go, again, 28 days is kind of splitting the difference between 20 to 40 days. And so what I'm going to do here is I'm going to look for something in the 30-ish delta here. And I'm looking at calls. So we're going to look at the right side of the page, left side of the page for calls. And I'm going to, I need more strikes, don't I? Let's do that. There we go. And that's going to be a 101 would be a 33 delta. I'm going to sell that one. Okay. I'm going to sell that one. Now, what else are we going to do? I'm going to do a long contract. I'm going to go out, again, more than 50 days typically on my long contract. Delta 60 to 70, maybe 67 delta. We're going to buy that one. I'm going to hold down my control key. Okay. We're going to right click on this. We're going to analyze this trade. Let's see what we got here. Move down. This is a bullish trade. It's a diagonal spread. It's a call diagonal. And it is one where the more it goes up, it's not a problem if it goes up more because this doesn't cross back down below our break-even line. Okay, so we're bullish on this. Our break-even is right around $98, just below $98. So we want to make sure that matches up with our technical forecast. Right now, stock is, so our break-even is basically kind of right where the stock is. The stock is right about there, and that's right where our break-even is right now. So we're bullish on this, and if it breaks down, I'm going to want to get out. I'm going to assume this is kind of a support level here. We bounced off it. We did pierce it there, but we closed intraday above that level, and we have our 20-day moving average there. So I'm going to say if we're breaking down below, I don't know, 95, we're going to look to exit on that trade. So let me go back. We're looking at this, and notice our theta is helpful, a little bit helpful, unless it goes against us. Stock goes down to 88, it goes down, we're going to be losing theta here. Where the purple line and the blue line cross is kind of where our theta changes from positive to negative on that. Right now, it is a positive Vega trade. The VIX right now is around 17 in the market, which is way down from where it was. And it made some of these positive Vega trades a little bit more difficult over the past month or so. Well, now that the VIX has come down from the stratosphere, it makes it a more doable thing. Even if the VIX stays, even if implied volatility stay roughly where they're at least it's not going to be damaging as opposed to if the implied volatilities were to drop a lot there on that. And let's see, what's our max gain on this? Our max gain here is right around $250 or so. So I'm going to say I'm going to get out at about $125. So let's do it. I'm going to right click on this. I'm going to go to advanced order. I'm going to first trigger as OCO. I'm going to right click. I'm going to create an opposite order. I'm going to do 2 of those. And that's my entry. I'm going to go market, good till canceled. And I'm going to get out if the stock goes below, did I write that down? I think it was 95. We're going to go if the stock goes below 95, less than or equal to 95. We're going to save that. I'm going to exit if we make $125. Well, 125 plus 450 would be 575. If we can get out at 5.75. Now, if I wanted to, I could, of course, put in an exit above a certain price on the chart and say, look, if we break out to, above 100, I'm going to get out. We'll probably be looking at it profitable at that point. But this is kind of the way I want to I think this is kind of a standard way to do it there. Okay. And that should be good till canceled on that one. And let me just hit up questions here on this before I submit or see. We got this. We've got our 3 trades. Our initial entry, which we'll say is about 455, we're going to get in. We're going to get out if it goes up to 575. We're going to get out if we break below 495. Okay. So let me just look. Questions. I think, and the long strike should be still higher than the delta. Yeah, and I'm going to review our rules here just at the end as we're wrapping up here. But I want to place this trade here. So this is an example of a bullish diagonal. This is a call diagonal, and I'm going to confirm and send. Make sure when you do these trades, you read the red markings down there. Okay, we're going to send that order, and it is sent. In terms of exits, if we haven't hit our targets, if things are going okay, we haven't hit our profit target, say on Walmart, the stock, say, goes up a little bit, but we haven't hit our profit target, we're going to wait. We're going to let it run. We're going to be positive theta territory on that. With less than 10 days to go to expiration, we'll probably just look to exit. Remember, early assignment is possible on these. Okay, early assignment is possible. Even if the short option is out of the money, it's theoretically possible that it could be assigned early. If it goes down, but maybe it hasn't broken our level here, but we're going, this isn't looking bullish anymore, you don't have to wait for that stop order to trigger or our exit order to trigger to decide, I'm going to look to get out now. I'm going to look to get out now. Okay, so that's money management on that. Just if things aren't going, if things are just kind of cruising along, going okay, but not great, 10 days or less till expiration. Okay. Ricebird brings up a good question. Can you roll the leg? Yes, you can roll the leg. You can certainly roll the leg. And that will generally should generate a credit if you just roll it straight out in time. When you're doing the trade, let me just go to that Walmart trade, for example. We have a June 13th and a July 18th. Let's say we get to the beginning of June and things are going okay. We haven't hit our target yet. You may consider rolling that June 13th out to maybe, I don't know, June 20th or something like that. I don't know exactly what the date would be. That, if we keep the same strike, should probably generate a credit at that point. And then you would be left with a June 20th short contract and a July 18th long contract. So absolutely you can do that. That is no problem. You're just gonna have to assess it at that time, and we'll take a look at it at that time if it comes about to be that circumstance. Just a reminder for everybody as we're looking at this, and I appreciate the question there, Ricebird. Remember that there is a survey link in the chat there. Everybody, we appreciate your feedback. These are the basic rules we're doing. I emphasize today are in the money diagonals, okay? But I wanted to show you just when somebody refers to an out of the money diagonal, what that is. But most of the rules in this class, typically we're focusing on those in the money diagonals. They are less Greek sensitive than calendars typically, but more directional than calendars. Calendars are more neutral type trades. And question, we'll just finish up with this. Where can I find more classes in this series, the prior 6 classes in this series? Well, this is the Advanced Option Strategies webcast. Barb, perhaps you could throw the link to the playlist in this class there. In that. So Frankie said, did I do both the bullish and bearish? I did. I only entered one trade. I just did the bearish diagonal. I just kind of showed the out of the money just to kind of show you the difference. But I only did the bearish trade on AbbVie there, Frankie. Good question there. So if anytime you go to the Schwab Trader Talks channel, by the way, go to the playlist at the top of the page. Advanced options class. There is click on playlists. Click on playlist there, and you can see the first 6 sessions in this series. Okay. All right, everybody. Thanks for joining me today. And coming up next, we've got ThinkScript Studies. We'll see you same time next week. Bye-bye, everybody.